Hello, everyone. Hope everything is well. Hope you are enjoying the holiday weekend. So, happy holidays, Merry Christmas, and Happy New Year to all of you. Now, we are going to be continuing from where we left off, and we are going to start ISA 240, which is fraud. Now, this is a very important standard, and I would rate it that, in a case scenarios or other exams you might be attempting, there is a high possibility that you might be asked to evaluate some fraud risk factors. Okay. Now, you must have seen a lot of news items regarding corporate fraud. Now, okay, I think the most famous one can be Enron, or the another, an example can be Enron. I think the most famous one. Another can be Satyam, right? Which are like large scale frauds. Now, whenever fraud happens, what basically it entails is that people will end up losing their money. So, auditor has a responsibility for fraud. Okay, so this is very important. The auditor has a responsibility for covering of the relating to fraud. However, just remember this little anecdote. Okay, I'm just going to type it here. Let me just take it here. Remember this. You correct this. I'll just write it here. You are not a cop. Yeah. Just keep this in your head. Like you possibly are not expected to, go all detective and find out the exact nature of fraud. But if you find something that looks too fraudulent to you, then you as an auditor have some responsibility. I'm just going to quickly start the standard. So the standard is responsibilities relating to fraud in an audit of financial statements. So scope, ISA 240 focuses on the auditor's responsibilities. Okay. For what? For detecting. Detecting means that whether fraud has occurred and addressing fraud in the audit of financial statements. Okay. So is the auditor responsible like a cop? No. Then what? Basically, who are the ones responsible? The ones who are actually running the show, right? Anyway, it builds upon the principles in ISA 315 and ISA 330. Hopefully, when we come to that, we'll see. Now, now, why is this standard important? That see, if you make a mistake, okay, if you make a mistake, it's let me just bring it here. Unintentional. Let me just put it this way: with the intent to deceive is a fraud. With error made, but there is no intent to deceive. That is an error. Okay, now see in either case, if your financial statements, in either case, if your financial statements have a misstatement, a material one, the financial statements will have some sort of will not be true, right, and fair. However, the problem that arises with fraud is that the intent. Okay, the key word over here, focus is intention. If you intended to deceive, okay, you wanted to make sure that no one catches your mistake, that indicates, just circle this box. If you intended to deceive someone, this is known as intent to deceive. Okay. Now, if you did not, but you made a mistake, that is an error. Now, fraud, obviously, if someone wants to mislead you, then obviously they don't want to get caught, right? So this is very important. This is the key aspect of the standard. Fraud involves intentional misstatements or omissions designed to deceive users of the financial state. Okay, so if they want to deceive you, for example, a company is in loss, they want to make sure that the company, you do not see the loss accurately, or the company wants to, evade some taxes, or the company wants to basically, get a higher share value, and the losses are there, so on and so forth. So if any of these things are happening, within this fraud, or someone is stealing from you. Okay, so what are the two types of fraud? This is important. Number one is fraudulent financial reporting, such as manipulation of financial data or misrepresentation of transactions. Okay, a very common misrepresentation of transactions can be of a expense is capitalized and loss is basically not shown. Now that is an example that your expense should have been expensed out, but you are capitalizing it. Okay, that's a very basic example. Misappropriation of assets, you know, including theft. You steal the asset. For example, you steal cash from a till, or misuse of an entity's resources. You are using, let's just say, the entity's stuff for your own good. Now you cannot do that. So these are all in the ambit of fraud. Auditors focus on fraud causing material misstatement, but do not make legal determination. Remember, you're not a cop, you're not a lawyer, right? You are only going to be seeing, hey, have I seen any indication of any fraud that can cause the financial statements to be materially misstated? If yes, if not, then we will move forward. Responsibility for the prevention and detection of fraud. This is important. Who is responsible to prevent? Like for example, have better internal controls, detect, for example, have better internal controls on the detection end as well. Who has the primary responsibility? Okay. So I'm just going to explain to you that management and those charged with governance, which are the directors, okay, those charged with governance, they are the primary responsibility for fraud prevention and detection. This is very important. Okay, I'm just putting a exclamation mark here that management is primarily responsible, not the auditor. Auditors are responsible for what? For obtaining reasonable assurance. Remember, reasonable assurance is not absolute, but a high level of assurance that the financial statements are free from material misstatements, whether due to any fraud or any error. Okay. In either case, fraud or error, your financial statements will be materially misstated. You, as an auditor, have the responsibility that you obtain some sort of a reasonable assurance that, hey, my financial statements look to be in a better or a good shape. Auditors are subject to inherent limitations such as collusion. Audits are subject to inherent limitations such as collusion. Collusion means two or more people are basically, working together to basically cause fraud and management override of control. Right? For example, the directors, start misappropriating cash through fake salaries, and they are saying, hey, payroll is under approval, which can hinder detection. So obviously, if a lot of people are involved in the fraud, difficult to detect. Important. Management override of controls, similar situation. And it applies to audits of financial statements of periods starting on or after December 15, 2001. Now, what are the objectives of this standard? Identify and assess risks of material misstatement due to fraud. Okay, so this is responsible. Okay, then implement appropriate responses to those risks. First, you see, hey, what are the risks that can happen due to fraud? Now, an example can be, Nowadays, not that common, but still can happen. A common example can be large cash transactions with improper transactions. Let me just miss the A. With improper controls. Okay, now that can be a risk. Hey, there's a lot of cash transactions, but the people are not counting the cash properly, or the cash is not stored in a safe properly. So then, you as an auditor design to implement responses, appropriate responses to address these risks to obtain sufficient evidence. You say, okay, if, for example, if I want to check the cash audit, I will see, hey, is there a safe? Who knows the safe code? Who counts the cash? How is the cash deposited? How the deposit slips kept, and so on and so forth, right? Okay, so we already know this. Professional skepticism, auditors must maintain a questioning mindset throughout the audit. Very important. Okay. You cannot trust or let things go slip through. You have to always have a questioning mindset throughout the audit. You cannot say, hey, I'm friends with the client now. Now I'm not going to be, and I'm going to trust them blindly. No, you have a questioning mindset throughout the audit. Be alert to conditions. Okay, you have to be aware that could indicate fraud and recognize that audit procedures effective for errors may not detect fraud. Obviously, because fraud will have this intent to deceive, so it's difficult to find. So you will say, hey, the procedures I did for my errors or my normal checking, for example, recalculation of depreciation expense. If it's made with the intent of an error, you just put the formulas in Excel and see if everything is okay. But if the management wants to basically underreport the numbers, then they might, not give you the fixed asset register, or tamper with the fixed asset register. So you might be alert that, hey, the procedures that were working for an error may not work for fraud. Engagement team discussions focus on identifying areas susceptible to fraud. Discussion among the engagement team. Okay. Topics include potential fraud risks. Always fraud might be perpetrated, and appropriate audit responses. Risk assessment procedures and related activities. Inquiries are made with management, governance, internal audit regarding fraud risks and controls. Analytical procedures and other risk assessment activities are used to identify unusual relationships or circumstances indicative of fraud. Okay. So you first basically, what do you do to assess the fraud risk? You ask the people, number one, inquiries. Okay. Management, governance, internal audit regarding fraud risk. You say, hey, where can the fraud occur? Maybe management tells you, hey, our warehouse does not have proper security cameras, or it suffers a power outage sometimes and security cameras are violated, so there can be inventory theft. Whatever the risks may be, then you say, okay, what are the analytical procedures? Okay, data analysis you do. Another risk assessment activities are used to identify unusual relationships or circumstances indicative of fraud. Fraud risk factors such as pressure, opportunity, and rationalization are evaluated. This is important. Okay. Identification assessment of risk. Auditors presume risks of fraud in revenue recognition unless specific evidence rebuts this presumption. Now, this is important. You identify the risk and then you make an assessment. Hey, the controls look good, the controls do not look good. You always presume that revenue recognition will have a fraud risk. Okay. Why? Because this is the main area in which companies want to do fraud so that they show a better picture than what actually exists. So unless and until evidence rebuts or contradicts this, you will presume that in revenue recognition there is always a fraud risk. Assess fraud risks are treated as significant risks. Obviously, there are, if you find a risk related to fraud, it is a very significant risk, and related controls are identified and evaluated. Then you see, okay, for example, if there's a large volume of cash transactions, you see, okay, what are the controls on the cash? Is the cash counted accurately, stored accurately? Are there segregation of duties, and so on and so forth? Okay. What are the responses to assess risks? You have identified the risk, then you make a response. Okay, now what will I do about the risk? Okay. Okay, you identify and then you assess and then you respond. What do? You cannot, act like a cop and start inquiries. You have to do it through your audit procedures, tailored to address fraud risks at both financial statement level and assertion level. Okay, assertions can be individual transaction account balances or disclosures, financial statement on an overall level. Introduce unpredictability in the nature, timing and extent of audit procedures. Nature, the type, okay, type of procedure, timing, and extent, how much. Okay. For example, you can do a preliminary stock count, a surprise stock check, a surprise cash count. Audit procedures addresses risks of management override, including testing the journal entries, accounting estimates, and unusual transactions. Right. Then you basically check for journal entries. You check for basically, if where management was overriding, you do procedures to identify those areas. Accounting estimates, for example, you go and assess the provisions more detailed. Now, then when you get these procedures, you get audit evidence. Okay. This audit evidence is evaluated. Evaluation of audit evidence. Misstatements identified are evaluated to determine whether they indicate fraud. You see, hey, is there an indicator of fraud here or no? If you suspect a fraud, auditors reassess the fraud risks, important, and the reliability of the evidence. Okay. Implications of fraud for the audit and financial statements are considered. Auditor unable to continue the engagement, right? If the fraud is suspected, you reassess everything because if you say, hey, the fraud is happening, then you say no. There are other areas which there can also be some sort of an issue, and the implications for the audit and financial statements are considered. You say, whether the whole audit has to be tested, whether you can actually do the audit, if the financial statements will give a true and fair review, will not give a true. You have to basically, if you are alert that there is a fraudulent activity going on, then you have to basically work on everything and look at everything with very keen eyes. Auditor unable to continue engagement. You say there's so much fraud, I cannot do anything. In exceptional cases of pervasive fraud, Enron was an example, but unfortunately, in Enron, the auditors were the ones who were also penalized heavily for their bad audit techniques. Pervasive fraud or compromise management integrity. Obviously, this is very important. The management is not showing integrity. Auditors may consider withdrawing from the. You say, hey, there's so much fraud, I cannot give you an audit opinion. Sorry, you might have to may even have to leave the audit in very exceptional cases. Okay, sorry. Let me just zoom in a little. Legal and professional responsibilities, including reporting to authorities, are evaluated before a withdrawal. Okay, you check the legal and professional responsibilities, written representations, obtaining written confirmation from management and governance regarding the responsibilities to prevent fraud and disclose known instances. Representation include acknowledgement of the role in maintaining internal controls to prevent and detect fraud. Written representation is, you get some sort of a written management letter that, hey, we know this is our responsibilities. So, and what does this include? They include an acknowledgement of their note, and basically they have to tell you when the fraud will occur. In maintain internal controls to prevent and detect fraud. They say, hey, management is responsible to prevent and detect any fraud. Communication to management of those charged with governance. Identified or suspected fraud is communicated to appropriate levels of management and governance, which is the board of directors, management, the senior management, and running the company. You say, hey, we suspect some sort of fraud going on. Fraud involving management or material misstatement is reported to governance unless prohibited by law. If this level of management is also fraudulent, then you might have to go to the directors, right? Unless and until there is a legal requirement in which you cannot go to the directors yourself, you just tell the directors, hey, we feel your management may have some sort of fraudulent activity going on. Please look into this. Reporting fraud to authorities. Now remember this, you are not a cop. Okay, so fraud to authorities like police or any other departments. Audit determines whether legal or ethical responsibilities require reporting fraud to a standard authority. Then you see, hey, am I bound by law to report this fraud? Are there any other laws or is there any other ethical responsibility that I have to tell it to the authorities? Okay, so what is the best case in if you encounter such situation? Go to a lawyer. So complex cases may necessitate legal advice, okay, to ensure compliance with confidentiality and reporting obligations. You just go to the lawyer and say, hey, I think there's a lot of fraud going on in the company. We were auditing. What do you suggest we should do? Should we go and tell to the authorities or should we not? What are the legal standpoints from the state? Documentation. Again, we've already studied documentation earlier. Simple. Audit document includes identified fraud risks, audit responses, what did you do for that, and conclusions, whether you found material significant risks due to fraud or not. Communications with management, governance, and external authorities about fraud are also documented. So thank you so much, everyone. Uh, Happy holidays, Merry Christmas, and Happy New Year, and hopefully see you soon.